How the government shutdown could cause a liquidity crisis in the financial system if the government isn't reopened soon. So, for those that have been watching the channel, we are well aware of the liquidity scarcity in the plumbing of the financial system in the overnight repo market. And a bit of an update, we did get SOFR for yesterday. Remember, there's a day lagged, and it is still notably above the reverse repo. It is notably above the discount window, which again is the Fed's upper bound, is 13 basis points above the Fed's upper limit. Remember, the Fed does not set one interest rate, they set a range or a corridor. And the blue line, the discount window or the standing repo, it's the same interest rate. That upper bound, we have been above for 6 days in a row. So here's kind of zooming in a chart I made in Excel from the Fed's data. And we can see that for the past 6 days, the actual cost of overnight capital, these overnight secured dollar loans, remember about $3 trillion per day in the repo market, financed in the repo market, the actual cost of these overnight secured loans, the interest rate is above the Fed's upper limit. So this is really, really worrisome, and because it is continuing despite the fact that it is not month end or quarter end. Here I will throw on month end, quarter end, and by the way, you can see that SOFR does pop relative to reverse repo, which is what we're looking at here. You can see a pop in SOFR either on the upper chart there or down here as a spread. You can see that happen at month end, at quarter end, but again, this has been developing outside of those events. We're talking about November 3rd, which was yesterday. On Monday, SOFR came in notably above the Fed's upper limit. And so there is undeniable evidence of liquidity scarcity in the plumbing of the financial system. In this video, we're going to talk about how the government shutdown could make it worse or arguably even trigger the crisis. So I also want to remind folks that's happening on the unsecured side. SOFR, about $3 trillion per day. That is secured overnight lending. The Fed funds, that is about 90 billion per day. That is unsecured interbank lending. And we can see that that interest rate has been moving higher relative to the reverse repo as well. So we have stress, undeniable. Again, if you look at the moving average here, it is undeniable that the actual cost of capital represented by SOFR has been increasing much faster than the Fed would like it to. Again, right now, about 38 basis points above the reverse repo. This has caught the attention of not only Jerome Powell, who gave an entire speech, by the way, talking about this exact stuff, but also Fed Logan as well, who said if the recent rise in repo rates turns out not to be temporary, the Fed would need to begin buying assets. That is QE. Now, not only that, but it is coinciding the dramatic rise in the SOFR spreads is coinciding with an increasingly frequent usage of the Fed's emergency liquidity backstop, known as the SRF. Not only that, but it is to an increasingly large degree. So here, by the way, was yesterday afternoon. $7.2 billion got tapped yesterday afternoon. This morning, $2.8 billion got tapped. And again, it is not month end, it is not quarter end. SOFR, the actual cost of capital for these overnight secured loans, is notably above the discount window rate, and it is not month end, is not quarter end. And as you can see, this has been building for about 2 months now. This is not a new phenomenon. Well, here we're going to overlay the Treasury General account and get into why the government is such a major part of this issue. So what I'm going to do is the Treasury General account here is, again, the government's checking account. This is just as you would like a buffer in your checking account, the government for operations would like a buffer in their checking account. Well, the problem is that due to the shutdown, none of this money is getting spent. Now, back here, we first flagged the potential for a liquidity event like we're seeing back here in late July, where the Fed, Treasury Secretary Scott Bessent mentioned that they were going to refill the Treasury General account because they wanted a bigger buffer. Here we could see got down to about 300 billion. He wanted to build it up to about 850 billion. Well, again, remember the reverse repo, which is a storage tank for excess dollars, was basically empty at the time that he said that. It certainly didn't have 550 billion in it, maybe 15 or 20. And so, again, what that means is that that money to rebuild the checking account balance from here to here had to come from somewhere else. It couldn't come from the reverse repo, which back during the last administration, when Janet Yellen would build back up the TGA, she did it twice, as we can see here. Back then, there was the reverse repo, which again, storage tank of excess dollars that the Fed tried to sterilize in a Fed facility to prevent it from going and causing inflation. Well, the reverse repo was empty when this, or near empty. Certainly didn't have $500 billion, which means that it had to come from bank reserves. Now, remember, bank reserves are half of the monetary base, and here they are inverted in the green line. And we can see a very, very tight correlation between bank reserves and that SOFR spread that we were looking at before, that SOFR minus reverse repo, the 10-day average. You can see that bank reserves are nearly one-to-one correlated, where, again, as the green line is going up, bank reserves are going down. And again, you would also see liquidity scarcity evident by a increase in the SOFR spread. And sure enough, that's what we saw here. That's what we saw here again. And there is a good, a relatively strong correlation between bank reserves and SOFR minus RRP, that SOFR spread. And again, it's because the reverse repo was empty. All this $500 billion that they wanted to build back in their checking account had to come from bank reserves. And so we have seen bank reserves just absolutely plummet. I will take off those here so that we can see exactly the degree to which bank reserves have declined. They've gone from about 3.4 trillion down to just 2.8 trillion. In fact, as a share of the M2 money supply, this is 13%. Well, the last time bank reserves as a share of the M2 money supply reached 13%, we had three of the four largest bank failures in U.S. history. And sure enough, what are we seeing now? We're seeing some regional banking stress. So again, all of the signs are pointing to the same thing, which is that as liquidity becomes more scarce because it's being removed by the Fed, number one, in their quantitative tightening, it's being removed by the Treasury General account, by the Treasury removing this amount of money, $680 billion has been removed by the Treasury and put in a checking account where it's just sitting there doing nothing. And again, the reverse repo was empty. So it couldn't come from the reverse repo. The storage tank, the buffer, the shock absorber was empty. Therefore, it had to come from bank reserves. Sure enough, we see bank reserves have been plummeting over the past 2 months. And again, that is half of the monetary base, or the M0. Well, normally this Treasury General account, the money, you might build up the balance, but then as you can see, you can spend it down into the economy. And again, when the line is going up here on the Treasury General account, what you are seeing is money being removed from the system and put in a checking account to just sit there. Well, as the line is going down, that is liquidity entering the system. And what we have now is they've actually overshot. So the target that they were trying to rebuild to was down here at about 850 billion. But what we can see is, due to the shutdown, more and more and more money, taxes are still being collected, of course, during the government shutdown. Those don't stop. And so as revenue is being collected, it's just going into this Treasury General account. It's not being spent into the real economy, into the banking system. So instead, the Treasury General account, this is a account that the Treasury Department has at the Federal Reserve, our central bank. Normally, this gets spent down and it goes out into the real economy and it enters the banking system. And therefore, bank reserves get some support. Right now, they have plummeted from 3.4 trillion down to just 2.8 trillion. There is quantitative tightening. There's a huge amount of debt being issued that must be bought with US dollars. And of course, the government is shut down. So the Treasury General account is removing liquidity from the system as well. And it's not getting respent out into the system. And so what is happening is we are getting a squeeze in the dollar. Now, those that have been watching the channel a while know that for the past month or so, I've been short-term bullish on the dollar. And sure enough, we are getting a pretty good squeeze in the dollar. And I just want to point out, Fed net liquidity, this is the Fed balance sheet minus the reverse repo minus the Treasury General account, inverted. So what this means is, as the line is going up, liquidity is tightening. And sure enough, we can see it has been tightening quite significantly over the past 2 months. A large portion of that is an emptying of the reverse repo, so that shock absorber's gone, and the Treasury General account, as we were just looking at, is just going up and up and up. More and more dollars being removed from the system, not being respent out into the banking system. And so, as we can see, there is a pretty good correlation here with the DXY dollar index, which again compares the dollar relative to other fiat currencies. We can see as the Treasury General account, that balance has been going up. We see the dollar has been strengthening, and Fed net liquidity, again, to a large component, is including that Treasury General account. And just a bit of an update on markets, the dollar has been squeezing quite notably, over the past 6 or 7 days. We can see the DXY dollar index moving sharply higher, bond yields as well. Of course, the Fed came out a bit more hawkish than the market was expecting. And of course, you might have some degree of liquidity strain as well. But a large portion of this is pricing out of interest rate cuts. You see a sell-off in risk assets like Bitcoin, and the S&P 500 gap down 1.1% today. It is trying to recover, but we saw volatility up with a 21 handle earlier this morning. So whether or not it's linked to this growing liquidity issue is anyone's guess. But again, the Fed is losing control over this overnight cost of capital. The SOFR, the actual cost of capital, is above their ceiling. It is above the upper limit, the discount window or the standing repo interest rate. We can see it's been above their upper limit for about 6 days, and to an increasingly large degree, about 12 basis points. Now, yesterday, again, it was more significant at 22 basis points. This is marginally improving, but it is not over at all. Of course, this was end of the month, so it's normal to see some liquidity strain. You would expect this spread to come in as those end of month strains fade away due to the calendar. So anyways, hopefully that was helpful. Treasury General account is a main player in the removal of liquidity from the banking system. And again, the longer the government stays shut down, the more the Treasury General account will just keep creeping higher as taxes flow in, and none of that money flows out into the banking system, into the broader financial system. That'll cause an increasing liquidity strain, again, as we have been seeing over the past month or two. And again, the SRF, the standing repo, the Fed's emergency liquidity backstop, it is undeniable that something has been building over the past month or two. SOFR minus RRP, even though it came in from yesterday's height of 48 basis points, it is still notably high at 38 basis points. Outside of yesterday, the last time that happened was the basis trade unwind of March of 2020. So anyways, hopefully that was helpful, and I will catch you in the next.